Hey friends, Barry Page here with another episode of Legacy Money, the show that helps you live more, give more, and leave more. In today's video, we're going to discuss financing and how to make major capital purchases. So the very first principle you must understand is you finance everything that you buy. You either give up the ability to earn interest by paying cash, or you pay interest to someone else for the use of their money. Now sometimes this is a head scratcher. It's hard to get your arms around because it's commonly accepted that when you pay cash, you save on interest. There are only two ways to make a purchase. Again, you can finance with someone else and pay interest, or you can pay cash and give up the ability to earn interest. So let's explore this and take a look at some examples. Let's assume someone has $30,000 and they want to make a purchase. We'll look at each side by side to see the possible outcomes. We'll start by looking at making a major capital purchase. Again, we're going to use $30,000 and we're going to let someone finance this $30,000 over 5 years at 5% interest. We're going to compare that to having $30,000 in an account earning 5% interest. What's the better solution? If they decide to finance the purchase at 5% interest, they will start with a $30,000 liability and make payments along the way. If they begin with $30,000 in an account and it earns 5% over 5 years, the final balance will be $38,501. The payment of $566.14 over the 5 years will leave the net balance at zero. So there is an alternative use of money. In an alternative account, you will deal with the lost opportunity cost if this account can earn interest. So let's take a look. If someone has a net worth of zero and they're starting to save money at $566.14 a month, the same as they would pay money in another account, they would do this at the same rate over 5 years, and this account would earn 5% for comparison. At the end of the first year, had they financed, the account balance would have grown to $31,535. And their outstanding liability would now have been reduced to $24,583. Had they paid cash, their monthly contributions of $566.14 plus interest would have grown to $6,952, resulting in the same net worth as financing. As we move forward in time, this continues. The resulting net worth in both scenarios is the same. Paying cash did not outperform financing, and vice versa. But what if one accelerates the payments on the loan? The results are the same. The liability is reduced sooner, but the long-term financial position of both strategies is the same. What I'm describing here, this alternative account, is a contract, a life insurance policy from a mutual life insurance company. Specifically, we like dividend-paying whole life insurance. The life insurance companies have actuaries design and build these contracts. They overbuild them to withstand the test of time, so they can pay death claims, expenses, and other administrative costs of the company. You can think of actuaries as engineers. They overbuild these policies to withstand the test of time. You have to qualify through underwriting for these policies or contracts. The actuaries work with a field of millions of lives that have gone through this screening or underwriting process to determine health and financial risk. Rate makers and attorneys then put it all together into legally binding contracts. These contracts are designed to get better every year based on mortality. For the most part, they're uncorrelated to the markets and the outside economy. These contracts offer the policy owner protection, savings, and financing options. The contract is unilateral and the policy owner is in control of the contract once the policy is issued. The policy owner has access to the equity or cash value in the contract. The cash value is used as collateral along with the death benefit to ensure that the loan is repaid. When discussing financing and opportunity cost, it's worth noting EVA, or economic value added. EVA was developed by Stern Stewart and Company in the 1990s. However, this idea has really been around since the beginning of time, although it may have been forgotten by most. EVA is simply earning more than the cost of capital. Put another way, when you know what's going on, you'll know what to do. This applies to the infinite banking concept as well. Before being introduced to EVA, corporations were borrowing capital from banks while putting little value on their own capital. They were treating their own capital as if it had no cost. Your capital has a cost. Once they changed their ways and incorporated EVA into their businesses, profits increased. This concept can apply to business or family finances. With the infinite banking concept, what we're discussing is making a major capital purchase and using the policy as collateral for a loan. The policy owner has access to the capital or equity in the policy via a policy loan. This equity, referred to as cash value, accumulates over time. The entire banking process is outlined on page 26 of the book, Becoming Your Own Banker. I recommend, if you want to understand this, that you pay close attention to this process. Banking is a process, it's not a product. When Nelson Nash described the infinite banking concept, he was talking about a system of policies that anyone can accumulate over time. It does take time and discipline. It doesn't happen overnight. It will take most people 3 to 5 years to accumulate enough capital in a policy to make a major capital purchase via a loan. It can happen sooner. Everyone's situation is different depending on how the policy is constructed and how the policy owner utilizes the policy. Every situation is different. Some will take more time and some will take less. But this time will go by anyway. You have to start somewhere. It's all about how the policy is funded and maintained by the policy owner. So thank you for joining me today. I hope you enjoyed this video. If you did, please give me a thumbs up. And if you haven't already, I'd really appreciate it if you subscribe to our channel and hit the little bell so you'll be notified when I come out with new videos. Until next time, thanks for watching.